they're going ahead and locking up some physical grain here. They think this is going to be a pretty value.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you, and we're going to be taking a look at Wednesday's market action with a little help from Relph. Well, I want to remind you to like these videos and also make sure you subscribe to the videos by clicking on that bell icon and share these videos with others. Well, as I mentioned, let's bring in Relph of Comstock Investments. Let's talk about the market action that we saw. And I'm looking at the grain markets on Wednesday, Eric. They seemed kind of choppy. I always tend to recall referring to that as a meandering market, where it just kind of drifts around, doesn't seem to accomplish a whole lot. Could you take much away from that?
I did today. Today was pretty significant in a couple of forms. And, I think the biggest is we saw new lows for the move in both December corn and November soybeans. So your key contracts of your major row crops both made new lows for the move. Not a good look, although we saw a nice rebound from the low in the beans. We didn't see the same action in the corn. Intraday, we did see some strength in wheat that did drag the corn along a little bit, but ultimately closed lower into the range and below $4 for the first time since the first month the contract was being traded.
Do you have any charts that we can take a look at then that represent the day's trading activity here? Why they gave you some telltale signs?
Yeah, so I'm going to start first with the November beans.
Okay.
I do a morning video for several dozen clients, and I made the comment after Monday's drop. We dropped 30 cents on Friday. We traded another 25 to 30 lower on Monday, posted a new low for the move on Monday. And I kept saying, as long as we don't close below that low, we're still okay. So I guess by my own terminology, we're still okay, but we did make a new low for the move. So Monday's low was 10.18 in November beans. Today, we traded as low as 10.15. So made a new low by 3 cents. But then we finished 7.5 cents off of that low at 10.22.5. And so we're still not in terrible trouble with regards to the November beans, but it's definitely not a good look. And now I wonder what kind of little rally back is going to be sold by farmers. There's a gap on the chart that we left on Sunday night that doesn't fill until we get to 1045. I think that's going to be significant. You've got some moving average resistance and some different things in that 1045 to 1065 range. And then you get into the pre-drop congestion area in the 1062 to 1086 range. So it's not going to take a lot of strength to get us back into some areas where I think we're going to see some grain move. I do believe that some physical grain capitulation has been responsible for this last move lower, because there was a lot of contracts that had to be delivered on by the end of the month. And here we are at the end of the month. So the last week of the month is always when you see that. And here we are 4 days straight down in the corn. We had similar action in the beans. So that definitely could be the case. Now the corn chart looks worse right now, but there is one thing we can hang our hat on, and I'll go over to that in just a second. But new low for the move. We took out the 403 low that we posted back on July 12th. That's not a good look. We closed below $4, but only by a quarter penny. So do I consider that significant? Probably not just yet. And here's why. When we look at the monthly chart on the December, when the contract came on, it came on at 395.5. We traded down today to 397.75, closed just a couple cents off of that low, down 5.25 at 399.75. So we're flirting with disaster here, and hopefully we can avert it as we go into the new month tomorrow. But right now, definitely not a good look from the chart standpoint for either December corn or November beans.
So it seems to be a bit of a tightrope walk here this week as we get into the month of August now.
Yeah, definitely. And that's the best way I can describe it. I'm getting calls from people wanting to bottom pick these markets, and well, should we be buying? And well, we're not seeing any confirmation yet that it's time to buy, but you got to think that we're close if we can hold these critical levels. And so, does a person want to buy some corn and risk a dime? Some will, and some have. And so that's some of what we'll be doing here over the next couple of days, I'm sure. And the same will be true of the beans now. We've got today's low as a parameter to work from. And are we willing to risk that parameter and see if we're not going to turn this thing around moving into the next month?
We did an episode, it's been several days back, but it was looking at the possibility of maybe at that time that being the bottom in the market. And We actually called that making the case for a rally in the grains or something to that effect for higher
Mhm.
grains. But you mentioned several things that had to happen for that to take place, and it seems like they all failed, haven't they?
Yeah, so far. Yeah, we did see a flash sale today of 104,000 tons of corn to unknown destinations. There had been rumors over the last couple of days that China's been shopping corn off the PNW. Don't know that that's where it went, but that's definitely a possibility. Significant Chinese buy-in is one of the things that we really need to see, and particularly in the soybeans, because our soybean export numbers are really lagging the USDA projections. If that continues to be the case, we could have both a supply and a demand issue at hand, and these prices may not be low enough yet.
Well, here's a question kind of out of left field for you. But if you take a look at the prices here on crude oil, up over $3 here on a Wednesday. Of course, things are really heating up in the Middle East now. Tensions are extremely high.
Mhm.
So naturally, the energy market in the form of crude oil took off and had a big rally. Corn, though, as you mentioned, was down there hovering around contract lows. It used to be if you had a big rally in the crude oil market, that would lift the corn market up because of
Yeah.
its tie, I guess, through ethanol. But why is it not doing it now?
I can't honestly answer that, Marlon, other than, our energy independence is a good thing in many ways, but in the case of the global market, I think we've become a little detached in that regard. So our crude oil prices, they're a lot more volatile than our grain prices. We know that, and they can be impacted by global situations. Our ethanol, not so much. So I don't know where the detachment honestly has come from, but you used to be able to lay a crude oil and corn chart over each other, and barring a few exceptions, I mean, they were almost mirror images. And so it's interesting how that's occurred, and it's only been over the last few years that they've just completely detached. Because I can remember in 21, as the grains had rallied out of late 20 into 21, looking at the crude oil chart, and that was when I started to notice, okay, we're not really following suit anymore. And the why of it, I honestly can't answer.
You know, when we began this podcast here, you talked about the fact that the wheat market actually acted pretty good early in the day, and then it just failed. I mean, it just failed the last half of the day once again.
Yeah.
What do you allude that to anyway with that action?
Well, I think that there's actually a lot of mixed emotions in the wheat market when you talk about what's going on with our domestic production. I mean, you've got record yields all over the country, and I'm just going to pull up a short-term chart here to show what the September Chicago did here today, and this is the 5-minute chart. So we were trading lower up until about 10 a.m. and then just had a sharp rally throughout the 12 o'clock time frame, roughly, I guess 11 o'clock. So for about an hour there, I mean, you just saw a nice sharp rally and then faded off for the rest of the day. And that rally actually carried corn into positive territory for a little while before it then again faded off and really lost traction by the end of the session. And it wasn't too different in the KC either. You can see their similar chart pattern. I mean, you made a low at 10 o'clock, you made a high at 11 o'clock or thereabouts, and then just fade off for the rest of the day and actually finish the day negative in the September KC. It's kind of interesting how the funds have been working these markets intraday. I can't tell you how many times we've seen, and we talked about this with maybe some fund liquidation being met with farmer selling by the time we get into the later portion of the session. But we've seen so much of this where maybe we see some market stability and some positive trade, and then that gets sold into as we get into the last couple hours of the day. And again, we're seeing that today in the wheat market.
Could there be a change in positioning as we roll over into the 1st of August here? How much would fund money play into that?
Yeah, it could be a fair amount of that. Honestly, I think that this we talk about month ends often, but this particular month end is a fiscal year end for a lot of people. They have a July 31st fiscal year end, and so August 1st starts their next fiscal year. And that's not only true of, small company, we hear about it with family members or whatever. A lot of farmers operate on an August to August fiscal year because of the way the crop comes out of the ground and what their marketing time frame is. But I think that has as much to do with it as anything, is farmers selling before the fiscal year ends which is now.
Anytime you get a market action like that, though, with a severe spike like that, and then it just stops just like that, that almost acts like it's just one or two players in there with a big position moving around.
Yeah, definitely the rally felt that way. The weakness early and late didn't necessarily feel that way, but the rally felt that way. And that's why I wonder if it wasn't some short covering here at the end of the month that led to that intraday move.
I want to change gears. Let me switch over here and let's take a look at this livestock trade as we headed into the end of the month. Kind of fizzled out after some fireworks earlier in the cattle and the hogs over the last few days.
Mhm.
Hogs had a decent performance led by the nearby contracts.
Yep.
Cattle, they seem to be led by the feeders, if you can even call it that. It didn't amount to much on the feeders. But was that because of the pressure on the corn, or what do you blame that
Yeah,
small rally on here?
the last couple days strength, particularly in front month feeders, seems to be a result of the lower corn. And even with people I'm talking to, I've got backgrounders and cattle feeders all over the country that are they're going ahead and locking up some physical grain here. They think this is going to be a pretty value added opportunity to control their inputs a little bit. So they're locking up some physical grain. I think you've got that kind of ideology going on that's strengthening the front end of the feeder cattle. And then in the case of the hogs, it was kind of interesting. Monday, we had a really for the hog market, which is a relative term. We had a pretty decent cash market action on Monday, and then yesterday was nothing. Super light numbers. The Packers weren't really bidding very aggressively, and so you saw just a lethargic trade in the cash side of things. And then today they came out guns blazing, and they were bidding up left and right. And you saw the last few session weakness that we've seen in the hogs kind of reverse course today, and saw some nice positive trade, and hopefully that'll get sustained. But you typically won't see more than 2 or maybe 3 days of Packers aggressively buying in a single week. But it's going to take something like that to turn this thing around. Although the cutout didn't move a lot, hams were down pretty hard, kind of keeping pressure on everything else. So the midday cutout was a little lower because of those sharply lower hams. So if we could muster the strength to get the cutout and the cash moving simultaneously, we might have something.
Well, as I look at a live cattle chart, now we've been up there in rarefied air, close to the contract highs, I believe. And here you're talking about corn in the neighborhood of making new contract lows. If corn does get into new low territory and open another leg down, would that mean a possible another leg higher in the cattle market than in live cattle?
I think it could. Yeah. I mean, generally speaking, you'll see it with feeder cattle are the most reactive, but longer term, that doesn't usually last. And I've had to make that argument with people many times over the years. When I started brokering, one of my mentors would always say, well, higher markets lead to higher markets eventually. And what he was referring to was the grains, and higher grain prices are going to lead to higher livestock prices eventually. And usually that is a correlation with the drought monitor as much as anything, and what the pasture conditions are looking like and all these things. And I think it's interesting. One of the things that I do is pasture, rangeland, and forage insurance, and that's just basically rainfall insurance. And it's mostly for cattle feeders with raw pasture ground, whether it's for grazing or haying. And although last year was widely drier or felt that way, this year the PRF insurance is paying higher indemnities for much of my plains and upper Northwest, I guess is how I would say it. Kansas, Colorado, Wyoming. Those regions are actually getting higher indemnity payments from the PRF insurance this year, even though last year felt quite a bit drier. Last year they were getting these sporadic, timely rains, whereas this year they had all their rain early in the season. So they've got full ponds this year, but they're getting higher indemnity payments on the rainfall insurance. So it's been kind of an interesting dynamic.
I was talking to some folks in the plains just today, and they're talking like temperatures are going to be above the century mark almost all week. And a lot of that area, if that's the case, you would think the weights would be going down on cattle. I thought that would have been supportive to the market.
Yeah, you would think that would be a little supportive. And, the reality is while we had a trickle of cash trade in Texas at 188, which is $2 lower than last week, that seemed like maybe a weak need early sale. Maybe they just had to get rid of them, financially or otherwise. And so you saw that one sale lower, and then I'm getting texts today, hey, I got bid 197. Have you heard any trade? I'm like, no, I haven't heard anything yet. So in the north, we've got some bids floating around at 197. Then finally, I get a confirmation from a producer or a feeder in Illinois, and he said just sold cattle for 198. Well, that's $1.50, $2 higher than his bid was last week. And so he went ahead and cut them loose at 198. So now I've had confirmed sales in Texas at 188, confirmed sales in Illinois at 198. So we're back to a $10 spread from north to south. And the way that they've been working the northern Kansas cattle is they've been pulling them up into Nebraska and selling them on the dress market or at the Northern Plains live market ish, So if we're talking by the end of the week, we may be selling 190, 192 in Texas and Kansas. They may pull those up into Nebraska and sell them for 194 to 196. So we could have a $2 to $3 increase in the national average cash, even if the Southern Plains doesn't move a whole lot, if the numbers are kept in the north. So it's kind of an interesting deal right now.
It's kind of risky just to even ship the cattle, right? When it's that hot like that.
Absolutely. Yeah. And we always call this the dog days of summer. This is a seasonal time when cattle have a downturn. People don't want to be moving the cattle. They don't want to be starting cattle, whatever the case may be. They don't want to do it. Nobody wants to do anything when it's 105 degrees outside. If you can stay out of it, stay out of it. And they will. And so you usually see this downturn in the market. If we can keep cash and box beef high enough throughout this week to overcome that initial downturn to start August, then maybe we do go and make another new high, and we haven't seen the high quite yet.
Well, Eric, it's great to talk with you again. Thank you for all the information. Great stuff as always. And we'll talk again soon. Eric Relph with Comstock Investments with a look at Wednesday's trade. That'll do it for this episode. For producer Brianne Hendrickson, I'm Marlin Bohling, and we will catch you next time right here on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.